All right, before we talk about our dividend portfolios and which dividend stocks we bought last week, let's look at what happened last week and why stocks have sold off so much. Right when I'm trying to get my classes ready for spring quarter, the markets decide to have their worst week since the pandemic. On Wednesday, after the market closed, the U.S. placed additional tariffs on numerous countries, causing stocks to fall on Thursday and Friday, putting many stocks in a bear market, including the Magnificent Seven stocks. On Thursday and Friday, many countries responded with higher tariffs, causing even more downward pressure on stocks. So what are the implications of these tariffs if they remain in place? Well, you can expect higher inflation because the companies that pay these tariffs are U.S. companies, not the foreign countries. And these U.S. companies will likely pass the higher costs on to consumers in the form of higher prices on their products. Higher prices, of course, means fewer sales, so you can expect lower corporate profits and earnings. And higher inflation means it's less likely that the Federal Reserve will lower interest rates, which slows down the economy. And obviously it means less global trade. Now, some analysts are incorrectly calculating the amount of tariffs based on the current level of imports, but increased tariffs mean fewer goods will be imported, thus resulting in far less money for the U.S. government than many are projecting. Now, I say these are implications if the tariffs remain in place. Them remaining in place is not a sure thing. Now, White House advisors on Thursday claimed the tariffs are non-negotiable, but 2 hours later, Trump contradicted that statement. No wonder there's uncertainty on Wall Street and investors are spooked. I believe the tariffs are part of a negotiation, but we'll see. The market is acting like the tariffs are here to stay. But I did move some cash into the market right before close on Friday by buying some dividend stocks that are already in our portfolio. Next week, we will get the CPI report, which is a report on inflation. It's one of the two big inflation reports that come out each month and could affect the Fed's decision to change interest rates. That happens on Thursday. Then on Friday, big banks like JP Morgan and Wells Fargo kick off earnings season, reporting their first quarter results. Many expect the companies will forecast poor growth over the next 12 months due to the tariffs. Some may even refuse to give guidance due to the uncertainty the tariffs are causing, and even the uncertainty about how long the tariffs themselves will last. Remember, Wall Street does not like uncertainty, which is one of the reasons for stocks falling so far this year. So all of our strategies are beating the S&P 500 from their inception date, except for our tech stock portfolio. But that's not much consolation when everything is down this month. As you can see on this slide, tech stocks as a sector have fallen 25% from their recent highs. That puts them into a bear market. Remember, a bear market is when something has fallen 20% or more. The so-called Magnificent Seven, the Mag 7 stocks, have done even worse as they have fallen 33% on average, with Tesla being the worst, losing more than half of its value since its recent high. Not surprisingly, dividend stocks have done the best. So what does this mean to us dividend investors? Well, yields are much higher and stock prices are much lower. The market will eventually recover, so I'm definitely continuing to add to my portfolio each week, hoping the sale on stocks continues. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but remember, you need to do your own research. Now on to the stocks we purchased last week. 90% of our portfolio, now we're talking about the dividend growth portfolio, 90% of our dividend growth portfolio is comprised of high quality dividend growth stocks, but the other 10% or so, actually it's 11% now, is invested in under-the-radar dividend payers. Last Monday, we added to two under-the-radar dividend payers, Meta and Salesforce. Meta started paying their very first dividends relatively recently and appears to be undervalued and is in the communications sector. Our dividend growth portfolio is underweight the communications sector when compared to the S&P 500, and I wanted to boost our allocation to that sector. We also made an additional investment into Salesforce. Salesforce initiated its very first dividend a year ago and recently announced it will raise a dividend. We added to this position because of the likelihood of it becoming a regular dividend grower in the future. It's also a super high quality company and in our opinion is undervalued due to the recent tech sell-off. Now, if you want to do your own research on companies that have recently initiated dividend, here is a good place to start. These companies have all recently announced they will start paying a dividend. Studies have shown that companies that either start a dividend or raise their current dividend significantly outperform stocks that do not pay a dividend. Now, many of these are smaller companies and therefore have greater risk, but also greater upside. It will be interesting to see which of these companies will become dividend growers in the future. Our biggest successes in this category of stocks is F&G Annuities and Repositrac, both of which basically doubled in the 12 months that we held the stocks. Now let's talk about the dividend growth stocks we bought last Monday in addition to those two under-the-radar dividend payers. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. On this slide are my ratings for the top 15 dividend-paying stocks this past week, but we only buy 10 per week. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow have already grown to be 4% or more of the portfolio, so we do not invest more in them this week because we want to build a more diversified, less risky portfolio. So that, in this case, that would be Microsoft and Allegion. Remember, we use many criteria to filter stocks. And if they are hovering at the required level, they can make the list one week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of the many filtering criteria we use to narrow down our list of investable stocks. Now each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week, or in this case 12 since we bought those two under the radar dividend payers. In other words, we reinvest dividends weekly into the stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top 10 stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks on the next few slides. Last week, I purchased over $2,700 of the stocks from Dividend Growth and High Yield as I reinvest dividends and gradually transfer out of my main dividend ETF, which is SCHD, and buy these stocks instead. Now, if you're investing in SCHD, you need to look at the recent reconstitution because it's super heavy in energy stocks. I don't know if you want to be super heavy in energy stocks or not. So you just need to be aware of what you own. I'm also trying to tweak the buying strategy a bit to see if I can boost returns, and I'll share those results as they come in. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or so of our purchases. The other 10 or 11% so far have been invested in those smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller. Now, Meta and Salesforce are an exception. But studies have shown they historically beat the market averages by a significant amount. Now, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes management's both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings. And remember, earnings are just a fancy word for profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. This slide shows our stocks in our various portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, adjust the shares held, and adjust the dividends per share that we've received once the stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if the company makes up more than 4% of their portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio, as many people are finding out now in the current market environment. Volatility often causes investors to panic and sell at the worst time possible. And the worst time possible is when stocks have fallen. So don't panic, people. Our portfolio holdings are now 105, with 89% of the weighting being in the high-quality dividend growers and 11% of the portfolio's weight being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a lot of time was creating the spreadsheet. That took 2 long years to create, and then you got to learn how to use it. All right. Now let's talk about the high yield dividend paying stocks we bought last Monday for our high yield portfolio, which is our best performer so far. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased these 8 stocks. And because the high yield stock portfolio currently has less than 1% in tech stocks, you might want to think about adding diversification to this stock portfolio if you're going to have this portfolio be the basis for your retirement funds. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. And as you can see, sometimes a stock will be in both rankings, like Comcast. So both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 are Novo Nordisk, which is new to our portfolio, Comcast, Target, and US Bancorp. And the 4 high yield stocks we bought last week while implementing strategy 2 are Comcast, PNC Financial, State Street, and PepsiCo. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grade for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. And so far, our past 22 dividend increases have averaged 10.2%, with the most recent ones being TriNet Group increasing their dividend by 10%, JP Morgan Chase by 12%, Build-A-Bear 10%, and Applied Materials by 15%. This slide shows the cumulative growth of the dividends we've received in our dividend-growth stock portfolio. Dividends for the month of February increased 70.2% over the same month a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main stock portfolios? The first reason is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion, that being that dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks on average. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks is measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend-paying stocks only invest in dividend-paying stocks that have increased their dividend recently. Along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first dividend, called dividend initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So investments made in stocks that raised their dividends or started paying a dividend grew more than double than if the stocks were instead made in stocks that did not pay dividends. 116.7% difference to be precise. So not only do dividend-paying stocks historically have a higher return on average than stocks that do not pay a dividend, and they have less volatility on average, they also perform better than non-dividend-paying stocks in down markets, also called bear markets, by 1 to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend-paying stocks hold up much better in down markets than non-dividend-paying stocks. This is from a report a study in the Journal of Corporate Finance. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time last year and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I invested in the stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investments that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in the previous year. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 and a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the dividend growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount per week was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom dividend growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, the inflation was even lower, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 on the first trading day of each week. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or maybe like 1 through 6 or 1 through 7. However, the downside is this reduces portfolio diversification, but some investors are more comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns by 45%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, you could try not limiting individual portfolio holdings to 4% of the portfolio's total value. So normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved the annual returns by 55%. But again, I personally prefer a more diversified portfolio. Number 3, so the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and ReposiTrax, 97% gain also in 12 months, on average, they've not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend growers is because many of those under-the-radar stocks are very small companies, and small stocks have not performed as well as big stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling when a stock is fairly valued, even if the dividend and quality metrics are excellent. So we don't sell stocks often in the portfolio and tend to only sell if the company cuts the dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to have your own valuation methodology, and then you also have to implement it on your own. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Now, most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually paid every other week, and it's automatically invested in their 401k. When I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Now, the advantage of investing every week, as opposed to every other week or monthly, is you get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, you would skip the under the radar dividend payers. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any questions, and also let me know what other portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!